You might think prop firm payouts are just easy profits. But the moment that money lands in your account, the taxman already knows. And how you handle it can make the difference between keeping most of your profits or losing a big chunk to taxes. In this video, you'll understand exactly how prop firm income is taxed in the UK, what setup makes sense for your situation, and how to avoid the most common mistakes traders make. By the end, you'll know how to stay compliant, save time, actually keep more of what you earn. Before we start, this video is for educational purposes only. I'm not a financial advisor or accountant. Always speak to a qualified tax professional to understand how these rules apply to you personally. Now let's begin. What prop firm income really is. The first thing you need to understand is that prop firm payouts are not capital gains. This is one of the biggest mistakes new traders make. You're not trading your own money. You're trading someone else's simulated capital, and at the end of the month, you're paid a share of the profits as a reward for your performance. So from the taxman's point of view, that payment isn't an investment return. It's income from work. You're providing a service to a company, and that company is paying you for that service. That's why, in almost all prop firm contracts, you are called an independent contractor or a self-employed trader. The firm doesn't employ you. You invoice them for your share of the profits. And that means your payouts are taxed as self-employment income, not as capital gains. You can think of it this way. If you clean someone's house and they pay you £100, that's income. If you help a firm grow an account and they pay you £1,000, that's also income. It's just a different type of service. Self-employed or limited company. So now that you know it's income, how do you pay tax on it? In the UK, you usually have two options. The first is being a sole trader. This is the simplest route. You register as self-employed, keep a record of your income and expenses, and file a self-assessment each year. You'll pay income tax and national insurance based on your profits. The second option is to create a limited company. This setup can offer some tax advantages, especially when you start earning higher amounts. With a company, you pay corporation tax on your profits and can decide how to take your money out as salary or dividends. But it also means more paperwork, more admin, and extra costs for accounting and compliance. So which one is better? That depends on how much you make, how much you plan to withdraw for personal use, and whether you have other income sources like a job or investments. There's no one-size-fits-all answer. A good accountant will ask you questions about your total income, family situation, dependents, and long-term goals before suggesting which route makes sense for you. Example 1. You have a job and prop firm income. Let's say you already work a full-time job earning $30,000 a year. Then you start trading with prop firms and make $70,000 in payouts during the same tax year. So your total income is $100,000. Now let's break down how much you pay in tax. In the UK, the first $12,500 of income is tax-free. That's called your personal allowance. Anything between $12,500 and $50,000 is taxed at 20%. That's your basic rate. Anything between $50,000 and $150,000 is taxed at 40%. That's your higher rate. And anything above $150,000 is taxed at 45%. That's your additional rate. So in this example, your job already covers $30,000 of your basic rate band. That leaves $20,000 left in that same 20% bracket. That means $20,000 of your prop firm income will be taxed at 20%, which is £4,000. The remaining $50,000 from your payouts will fall into the higher rate band at 40%, which equals £20,000. So your total income tax from the prop firm income is roughly £24,000. But you're not done yet. As a self-employed trader, you also pay national insurance. There are two types. Class 2 is a flat weekly rate if your profit is above about $6,500 a year. It's around £3 a week, or roughly £158 a year, Class 4 is a percentage based on your profits. You pay 9% on income between about 9 and 50,000 and 2% above that. So for your 70,000 in payouts, you'd pay 9% on 41,000 and 2% on the rest. That's roughly £4,000 in national insurance. Combine that with your 24,000 of income tax, and your total tax bill from the 70,000 payout is about 28,000. After taxes, your take-home amount would be around 42,000. That's a big difference from the 70,000 you started with. And this is why proper tax planning is so important. If this breakdown is helping you understand things clearly, take a moment to like the video and subscribe to the channel. It helps a lot. And if you want to check out the best prop firms in the UK and grab promo codes, the link is in the pinned comment below. It also helps support the channel. Example 2. Prop firm is your only income. Now let's look at what happens if prop trading is your only source of income. Let's use the same 70,000 payout as an example. The first 12,500 of that is still tax-free. From 12,500 to 50,000, you pay 20%. That's 37,500 times 20%, which equals about £7,500 in tax. Then, on the remaining 20,000 between 50 and 70,000, you pay 40%, which equals £8,000. So your total income tax will be about 15,500. Now add your national insurance. Just like before, you'll pay about £158 for Class 2, plus 9% on the income between 9,000 and 50,000, and 2% on everything above. That comes to roughly another £4,000 in national insurance. So the total is just under 20,000 in tax and NI combined. From your 70,000 payout, you'd keep about 50,000 after taxes. So compared to the earlier example, you actually take home more if prop trading is your only income because you get to use your full personal allowance and you stay longer in the lower tax bands. This shows why every trader's situation is different and why it's important to calculate based on your own income mix. Why you need a proper accountant. Now let's talk about accountants, because this is where a lot of traders make mistakes. Many traditional accountants don't understand prop trading. They might know normal self-employment or investment income, but prop firm payouts are a hybrid between the two. That means you need someone who actually works with traders and understands how these firms operate. When you're choosing an accountant, ask them if they have clients in the trading or prop trading space. Ask if they know how prop income is taxed, and if they've handled these returns before. If they say things like, "You'll pay capital gains tax on that," or "I'll need to research it," that's usually a red flag. A good accountant will explain that prop firm payouts are income and will guide you to structure your taxes correctly. The average cost for an accountant can range from around £850 to $3,000, depending on how complex your setup is. But remember, this cost is deductible. You can expense your accountant's fee when calculating your profits. A specialist accountant might even help you find small tax efficiencies you didn't know about, saving you far more than what you pay them. Keeping records and planning ahead. Let's talk about staying organized. One of the simplest but most important habits for traders is to set aside a percentage of every payout for taxes. A good rule of thumb is to put aside 30 to 35% of your payouts in a separate bank account. That way, when tax season arrives, you're ready and not scrambling for cash. Keep a record of all your payouts, invoices, and related expenses. Things like your trading computer, software subscriptions, internet costs, or education materials can often be claimed as business expenses. You don't need expensive software to track this. A simple spreadsheet or accounting app works fine as long as you stay consistent. It's also smart to note the dates of your payouts and keep proof of payment. This helps your accountant prepare accurate returns and ensures you stay compliant if HMRC ever asks for details. Limited company versus sole trader recap. Now that you've seen both examples, you might be wondering if setting up a limited company could reduce your taxes. In some cases, yes. A limited company allows you to separate your personal finances from your trading business. You'll pay corporation tax on the company's profits, which would be lower than income tax at higher earnings. Then you can pay yourself a mix of salary and dividends, which might reduce your total tax bill. However, a company setup comes with responsibilities. You'll need proper bookkeeping, annual filings, and more professional help. If your prop income is still small or inconsistent, being a sole trader is usually easier. As you grow and start making consistent, higher profits, that's the time to revisit the company option with your accountant. Final thoughts. Let's summarize what we've covered. Yes, prop firm payouts are taxable in the UK. They count as self-employed income, not capital gains. You could trade as a sole trader or through a limited company. Each has its pros and cons, depending on your earnings and goals. If you have a job and trade on the side, expect a higher tax rate on your trading profits because your salary already fills the lower tax bands. If prop trading is your only job, you'll keep a larger share of your payouts because you can use your full personal allowance. Always track your payouts, set aside money for taxes, and claim legitimate expenses. And most importantly, get a good accountant who understands prop trading. That one decision can save you both money and headaches in the long run. If this video helped you understand prop firm taxes more clearly, give it a like and subscribe to the channel for more trading guides like this one. And don't forget to check the link in the pinned comment to find the best prop firms in the UK and promo codes. It helps support the channel and might help you save on your next challenge too. Thanks for watching, and I'll see you in the next one.